Thomas, good to see you. An important lesson for everyone today. Stop using the S&P 500 as a benchmark. When we hear the headlines about the markets, it is often about how the S&P 500 is doing. And the S&P has been on a rally lately. Take a look at this chart from FinViz, which shows it year to date. So some of us then look at our portfolio and wonder why it's not up the same amount. So Thomas, why don't I invest in what's doing well right now?
Well, I think a couple of things you need to think about. First of all, is how is your portfolio diversified? The S&P is a collection of 500 of the top companies, and it's all stock. So you may not even have that type of portfolio. You may not be 100% in stocks. You may be a 60-40, 70-30 split between that and bonds. So that's one thing. The second thing is there's multiple sectors in the S&P. And some of the sectors may be overperforming versus the other sectors. For instance, right now, the tech space right now is just overperforming due to what's going on in AI. You see a lot of the Apples, the Googles. They are just increasing the value. They're performing. They're knocking it out of the water right now. But other areas may not be performing as well. So I think that it's important to see how your portfolio is diversified before you try to make that comparison.
And we all know that diversification is important to long-term success, but market history has proven that a well-diversified portfolio will almost certainly underperform broad markets and most individual asset classes in the short term. So when we look at something like those tech stocks making huge gains, what should we be keeping in mind?
What is your long-term strategy? Because as of right now, this year, techs may be performing incredibly well. Next year, they may not be. So having a long-term overall strategy is what I would advise any client that has a portfolio to have that disposition when they're building their overall portfolio.
And when we see the markets going up, even though, of course, we all want to see huge gains, big swings like that just might not be in line with our risk tolerance.
Yeah. Is it realistic? Do you want to be 100% weighted in tech stocks? That's probably not the smartest thing to do. So while there might be some people out there as stockbrokers trading those types of positions, I am all for, diversifying your risk so that in the event that particular sector, sees a major decline, it doesn't impact your overall portfolio as significantly.
So, Thomas, then why do we make irrational decisions about our money?
It goes. I remember when I first started in this business, and I had a teacher, if you will, a mentor, if you will, talk about that, and it all kind of goes back to how you were raised and how your philosophy of money. But a lot of us, many of us, have emotional connections to our money. If we lose or if we gain, so making decisions in that euphoria phase may not necessarily be the smartest thing to do. You may not want to sell or you may not want to buy. But I would say having a long-term strategy and sticking to that versus leveraging your emotions, because irrational decisions can lead to major impacts in your overall portfolio.
You're right. It all comes back to having a plan. So, Thomas, if somebody would like to talk to you about creating a financial plan, what's the best way to reach you?
Yeah, definitely. Go to my website, martinheritagegroupllc.com. You can obviously shoot me an email as well at info@martinheritagegroupllc.com. You can give me a phone call, 651-503-6064. And then I'm on all social media platforms at Martin Heritage Group.
All right, Thomas, thank you.
Thank you.